Good morning, everyone. Pleasure to be back here at the Dubai FinTech Summit. Interest rates, inflation, and the US economy, three things that are watched closely by businesses all around the world. If we needed a reminder, Matthew, of the importance of the world's largest economy, I think we've all seen it in recent months. Decisions out of Washington being watched very closely. How nations are responding to those have sent shockwaves throughout the global economy. There are the more structural issues as well, interest rates higher for longer, as well as inflation that are continuing to weigh on corporations and consumers worldwide. A lot to unpack in 20 minutes, but I'm going to start, if I may, with the US economy, the world's largest 0.3% contraction in GDP in the first quarter of this year. Give us your assessment and outlook on the strength of the US economy today.
Let me start by saying it's great to be here as well, so thanks for having me. It's an honor to be here. Bank of America set up operations in the UAE back in 1972, actually, so we've been here for 53 years, which is quite a long time, and we look forward to continuing to be here for a very long time. But 20 minutes to unpack what's going on around the world and in the US is not very long. Let me start by saying, though, when we look at global GDP growth, just to put it in context, we're now forecasting global GDP growth despite all of the noise, despite all of the issues which we've seen, whether it's trade-related or tariff-related or just a general slowdown in activity or geopolitical issues which are outstanding. We're expecting growth to be 2.8% this year globally, which is down only 40 basis points from where our economists were forecasting growth at the beginning of the year, and next year growing to 3%. And when you look around the world and you look at which economy is going to be most affected by what's going on, it really is mixed. In the US, we're forecasting 1.5% growth this year and 1.5% growth next year, which is down 90 basis points from where our economists were before the noise. And it's hard to anticipate what the future may look like, but I do think it's fair to say that the risk is to the upside on these forecasts, because we're heading into a period where there is a high degree of desire to resolve some of the issues which are currently plaguing the markets. We have seen this uncertainty shock create a little bit of a stall in business activity. We're seeing companies want to pause investment decisions until they have better clarity on the future. We're seeing companies want to pause hiring decisions. They're not hiring a lot of people, they're not firing a lot of people. So we're in this period of wait and see, and I think that you're going to come out of this period pretty quickly. So we should see growth accelerate into the second half of the year and certainly into 2026. I would also say the bid-ask spread on what's going to happen is wider than it normally is, whether it's on growth, which is strong, or inflation, what may happen, or interest rates. So just turning to inflation very quickly, I think you have to look at inflation not at a point in time, but over a period of time. And I think the media is great at looking at everything in a point in time. But if you look at inflation over the last few years, clearly since COVID, inflation peaked at 9%, 10%, 11%. In most markets around the world, inflation has now decreased significantly, between 2 and 2.5%, call it. And the question is, what's going to happen and how long will that happen for? So if we look at the impact of what's going on around the world now, this uncertainty shock we're seeing, what's happening with supply chains, we think our economists forecast inflation may peak this year in the US at around 3.5%. Much lower than what we saw during COVID. And the big question is whether or not that inflation is transitory, whether it sticks around into 2026. We believe it comes off later in the year. We do believe it will be transitory. And the effect of it will really depend upon how quickly we get some of these trade agreements up and running. And again, if you look at what's happening, there seems to be a strong desire to get this sorted out quickly. Yeah. And then turning finally onto interest rates, what's happening with rates as a result of all of this, then rates are decreasing around the world. We think 125 rate cuts this year globally. So at the beginning of an easing cycle, given growth is slowing down. And important, we're not going into a recession, we're just seeing a slight slowdown. In the US, however, we think that rates won't be cut this year, and the Fed's been reasonably clear on that. We think rates will be cut next year. And the situation may become more difficult if we see inflation. The question is, how transitory is that going to be? Question is, what are inflation expectations looking like? We can talk a lot about that, and how strong the employment market is. It's a long answer to a short question, but we feel reasonably comfortable we're heading into an okay zone here.
Thank you. That's a good assessment of the three main things we were looking to cover. US consumers have traditionally been a stronghold of the economy, about 70% of GDP coming from consumer spending. That's a relatively high figure, however you look at it. These concerns that you touched upon there, we've had news in the last 24 hours of a potential deal, more details set to be announced today, according to the Treasury Secretary, Scott Bessent. How concerned are US consumers, do you think, about what's coming ahead?
Right. Well, you're right. The US consumer is very, very important. $30 trillion economy. The US consumer is 70% of that economy. That's a $21 trillion economy in the US consumer. It's bigger than every other major market in the world, including China. So what happens with the US consumer is important for what happens everywhere in the world. And I think that when you look at the US consumer, it's also very easy to look at a data point. What's happening with retail sales this month? What's happening with consumer confidence and expectations? And those data points are all good, but you have to look at it as part of a time series and as one factor when you're assessing the strength of the US consumer. I think the right way to look and analyze the US consumer, the US household sector, is the same way that you look at a corporate. You'd look at the balance sheet of the consumer, in this case the household sector. You look at the liquidity position of the consumer, and you look at the income statement of the consumer. And just give me a minute on each of them. When you look at the balance sheet of the consumer, the US consumer has never been in a healthier position. If you look at household debt to GDP, it's at just under 0.7 times, which is the lowest it's been in 25 years. If you look at total assets of the household sector, compared to total liabilities of the household sector, the current ratio is 940%. Very well capitalized. So we have no capital structure issues. In fact, if you look at household wealth, it's $160 trillion. It's up $50 trillion in the last 5 years alone. And if you look at household equity in the United States, $35 trillion, up $15 trillion in the last 5 years. The consumer is very strong from an asset perspective. So the next question is, okay, that's great. Households are illiquid when rates are high. It's hard to sell in the secondary market. Sales are down. You've got a lot of income, a lot of assets in the stock market. That's volatile. Can you sell? Is it liquid? So let's look at another ratio, which is liquid assets, which includes just cash and money market funds to total liabilities. That ratio currently stands at 99%. Also up significantly in the last many years, over many years. And if you wanted to put equities in there as well, then the ratio is over 300%. So there's no problems with the sector from a liquidity perspective either. And then the question comes, well, what happens with current earnings and income? And this is what the market's focused on, strength of the employment market. Employment is strong. We've got 4.2% unemployment. It's the lowest in 60 years. Job growth is still strong. But the question is, what happens next? And this is what the market's very, very focused on as it relates to the uncertainty shock which has been put through the system. But I think it's also important to remember that there's a big supply-demand imbalance in labor, not just in the US, but in many developed markets around the world, and that's going to provide a structural underpinning to a relatively strong labor market going forward. We're still seeing wage growth. Yes, it's coming off. We're still seeing a reasonably healthy job market for people who want to switch jobs, although that's coming off a little bit. And there's no doubt that consumers are a bit more concerned about the employment market in the future. So we are watching it very, very carefully. All of that is translated into very resilient consumer spending. We look at this on a daily basis and a weekly basis. If you look at the April data for credit and debit card spending for US households, it's up 1% versus being up 1.1% in March, and very much in line with what you'd expect for an economy growing 17, 18, 19, but back in those years at around 2%. So we haven't seen it fall off yet. If you look at companies' earnings announcements, clearly there's some weakness with the lower income consumer, which we'd expect, but there's no systematic trade down yet. There's a high degree of cautiousness in terms of looking at the future, but we haven't seen it translate into spending yet. So we're going to watch this very, very carefully and see how companies react.
And you mentioned the healthy, balanced position that the US consumer is in. When it comes to the conservatism that you touched upon from the Federal Reserve and cutting rates this year, one thing that they look at closely is the risk of inflation and how that's going to hurt people on the ground. Do you think that's warranted, the sorts of conservative...
Well, it's warranted in the sense that it's certainly warranted, because when you look at, and this is one of the things which I think is very unusual, if you look at what consumers are saying about the future, and they have been saying this for the last few years, they've been concerned about inflation, they've been concerned about the job market and future earnings, they've just been concerned about geopolitical issues, and the concern has been increasing. However, if you look at how that translates into current spending and activity, there hasn't been much of a change. So we're in this interesting situation where the consumer is getting more and more concerned about the future, but they're not yet changing how they behave. And we keep asking ourselves, when is that gap going to close? And in the current spending data, it's not going to close. Of course, the Fed looks and is very focused on inflation expectations for the future. And if you look at the most recent data from the University of Michigan survey, inflation expectations, whether it's 1 year or 5 years, are the highest they've been in a long time. In fact, it's 6.7% for the next 1 year inflation expectations for the consumer, versus our forecast, as I mentioned before, of a 3.5% inflation rate in the US this year, assuming the costs we expect to get passed on through the system actually get passed on through the system, which may not actually happen. So yes, the Fed has to keep inflation expectations anchored. That's very important. The Fed also has to make sure that they understand whether or not the bump in inflation which we may see is permanent or transitory, or how long it will last for. The Fed also has to be very concerned about what happens with the employment market, which is why they need to take this wait-and-see approach for each of these three and other reasons as well. So yes, it's a fair concern. Consumers are definitely concerned about it. They're telling us they're concerned about it, but they're not changing how they spend just yet.
And another interesting factor about the US economy is how many people own equities and stocks.
That's true.
And that's been seen as a bellwether of sorts about the Trump administration's success with the handling of the economy. Very different issues, markets in the economy. But do you expect the exceptionally strong run that the US markets have had to continue?
Well, the answer is, it's a complicated one, I guess, but to simplify it, yes. When you look at the US, and you think about the foundation that the US has for future investment, we think it's very, very strong. Clearly, you have a very attractive consumer market, as we've talked about previously. You have a very attractive labor force in terms of flexibility, geographic and structural flexibility in terms of where it can move. You have energy independence. You have a very strong culture of innovation. And if you just look at a few stats on that front, 80% of the MSCI World Index Technology Index is based in the United States. If you look at research and development spend as a percentage of GDP, in the US it's 3.6%, it's much higher than in any other developed market. Or if you look at the amount of venture capital investment in the US as a percentage of GDP, it's also double the nearest developed market competitor. So this culture of innovation and excellence which is going to continue. You obviously have a lot of investment coming into the US. And this is not just about what's happening now. This has been happening for many years now. China plus one strategy took off many, many years ago under the first Trump administration. We've seen a ton of reinvestment in the US, more CapEx, more employment, more FDI. In fact, the FDI is the US has attracted $5.5 trillion of foreign direct investment over the last 25 years. And if you think about portfolio investment into the US, then we've seen the ownership of foreign assets in the US go from about $3.7 trillion back in 2000 to $30.7 trillion at the end of 2024. The US is going to continue to attract a lot of capital. And then in the previous session, you heard about really the underlying strength of the US dollar. So there's a lot of factors here, which means that the US dollar, I think it's been what you've seen, the narrative out there, it's like if you're in a car accident and there's been a little bit of a dent on the front fender. That dent can be repaired pretty easily without a lot of cost, without a lot of time, or it can just sit there and not affect how the performance of the economy actually goes. So we're not sure what the answer is going to be. I think that dent will be fixed quite quickly and the economy will be growing once again. And all this noise which is being created out there, it's really just a moment in time, but it's not going to affect the structural underpinnings that we're seeing here.
Yeah, and those deals could be crucially important. More details expected in the coming hours on the US and China. But let's just finish. We've got about 5 minutes talking about this part of the world. We're here in Dubai in the United Arab Emirates. President Trump set to visit in the coming days Saudi Arabia, the UAE, Qatar. You mentioned capital and FDI into the United States. This part of the world increasingly important in that equation. What's your assessment of Bank of America's role here in the Middle East, and where do you see growth?
Well, thanks for asking about Bank of America. Like I said, we've been here for 53 years. We like it a lot. We've got quite a few businesses here. We have our global corporate investment banking business here, serving institutions and companies around the region, based out of Dubai, which is fantastic. We have our institutional markets business here. We have our payments business here. And in fact, we've got our emerging markets research base out of Dubai, which is also fantastic. We have seen a lot of pickup in activity over the last 10, 15 years. We tend to be top 3 in each of the businesses we're in. We're the leading equities business in the region. We see a tremendous amount of interest, ongoing interest from all types of institutional investors. In fact, we had our Global Investor Summit. We've only done it for 3 years. We had our last one this year here in Dubai in February. And we appreciate the support of the leadership of Dubai in making that happen. We had 300 senior investors here from all around the world, and 250 of them came in to the region, which was fantastic. So when we think about capital formation, obviously a lot is coming out of this region. When we think about capital deployment, we see a lot coming into this region. And it's very unusual to have that combination and that nexus. And when institutions around the world are looking for growth and the new opportunity, then the Middle East is at the top of that list for a large number of reasons. And it's good to see that, similar to the foundation I mentioned, which has been built in the US, which is going to support the US exceptionalism narrative for a long time, that's a similar story, a similar foundation has been built and is in the process of being built in Dubai and around the region. So when you look at the vision, the pillars of that vision for Dubai, they're all incredibly attractive from an investor and a corporate perspective, investment perspective, and we think institutions and corporates alike are going to be very attracted to the region for a very long time. We want to intermediate that. That's our job, and help facilitate that.
And just to pick up on that, that brings me perfectly on to the next question. A group of CEOs will be traveling with the president on this official visit to the 3 countries. There will be deals announced, billions. We're expecting the UAE has already earmarked 1.4 trillion to invest into the US. You must be expecting to pick up a share of that, and how are you looking to do that?
Well, we like to intermediate all capital flows, you're right, whether it's corporate or institutional. And I do think we're going to continue to see a very large amount of inflow into the United States. And it's not just from this region, which is great, but if you look at all regions around the world, if you look at Europe growing at 0.8%, and the size of the European markets versus the size of the US markets, and you look at the competitive dynamics for many European companies, whether it's administration, whether it's energy, whether it's what's happening in the emerging markets and with China, a very important component of growth in the future is the US. People have to be there. They're going to invest from all around the world, and our job is to intermediate that in a very constructive and innovative way.
And are there, just a couple of minutes, are there any sectors in particular that you're looking to target? AI has been mentioned as one potential area for the US and this part of the world to ramp up investments. What are you looking at when it comes to
Well, I think it's really,
financing?
I like to say this, it's across all sectors now. And we're relatively agnostic to what we want to intermediate and where we want to participate. But clearly technology and AI is at the top of the list. Healthcare and biotech is a narrow second. Infrastructure all over the world, particularly in the US, when you look at the age of the capital stock in the United States, there's a lot of infrastructure formation which needs to be put in place across all sectors of infrastructure. It's new energy and the energy transition generally, which is still going to happen, maybe at a slightly slower pace than what people had previously thought, but is still clearly in the desires of most people. It's the consumer and everything about targeting the consumer. So it's healthcare, given the aging populations and the dynamics around that. So there's a lot of big structural, demographic, and generational changes which are happening. Some of which we're partway through, some of which we're just at the beginning of. And how we think about capital deployment is based upon the type of industry and the stage of formation of that industry. But it is very exciting. We're at a time when there's thousands of unicorns around the world who are all targeting specific niches in each of these areas, and many of them are going to be incredibly successful. And part of the challenge is figuring out which ones they're going to be and how do we invest in them for the long term.
An optimistic end to note on. Matthew Koder, the President of Global Corporates and Investment Banking at Bank of America. Thank you.
Thank you very much.